With the credit crisis easing and the economy improving, deal-making, it started to make a return. But how far, how fast, and is there a lot of money left? We'll find out. Let's bring in an expert, because last spring, Raymond James Financial purchased the boutique banker Lane Berry and made Fred Lane its vice chairman of investment banking. Fred, it's good to have you with us. Thanks for coming in.
Nice to be here.
So what's the state of mergers and acquisitions and deal-making? Is there money available for such activity?
There is. I think most of the activities in the corporate arena, meaning strategic deals, these are not financial recapitalizations. These are strategic deals driven by revenue synergies and cost synergies, extension of product lines, buying technology, buying content. We've seen examples of this. Disney buying Marvel is a great example, where Disney's distribution capability and Marvel's content, underexploited, according to Disney, is a match made in heaven. We're seeing it, I think, with HP and Dell. HP buying ACS, Dell buying Perot Systems. Again, we're seeing the need for services, and in the case of HP and Dell both, some desire to diversify their business away from just product-driven revenues. So I think we're seeing that. I think in general, corporations are flush with cash. In a downturn in the economy, working capital is freed up. A lot of corporations have paid down debt, not dissimilar to the consumer, I might add. And they have a lot of cash, and they've deferred capital expenditures, just as we've deferred, putting new windows in or putting that new deck on the back of the house.
Talk a little bit about Wall Street's perspective, though, because as an investment banker and someone that sold his firm recently to Raymond James, what's the outlook on Wall Street? Is it getting easier to get deals done, or at least get in front of potential deal makers?
Oh, I think it's a lot. I think the market or the environment to get deals done has improved a lot. It's gone from zero, horrible, to not very good, but getting better. So I think if you compare the current environment to 2005, 2006, and 2007, it's a lot worse. But is it fundamentally a sustainable and likely to be improving environment? Yes, that's true too. Credit-worthy companies, particularly larger credit-worthy companies, are certainly having access to capital. The smaller company, the highly leveraged company, in this kind of economy, given the outlook for our GNP growth, which is not that aggressive, I think those companies are going to be under some credit pressure on an ongoing basis, just as the consumer credit piece is also contracting. It's not growing.
Sure, we know about the personal savings rate, for example, and revolving credit as well as non-revolving credit. Right. When you look at Wall Street, though, do the big get bigger, the small take little boutique areas, and the middle? What happens in the middle market? Does that get really tough?
I don't think that's actually happened. I think we've seen something else happen. I think we've seen the universal bank model largely discredited. We've seen the largest banks who really have tried to combine lending with investment banking do only a moderately good job at that, and frankly, because of risk control problems, they really didn't allow themselves to manage their balance sheets properly. So I think there's been a retreat actually from using debt and credit to drive investment banking revenues, and so I think instead we're seeing something different. With the demise of Lehman and the demise of Bear Stearns, we're seeing the middle market firms grow rapidly. We're seeing Raymond James obviously buying Lane Berry to grow. We're seeing firms like Jefferies add people. We're seeing regional firms become national firms and focus on the middle market. And frankly, they're going to move up market as well, because the large firms are, by and large, focused on the Fortune 200 or 300. They're really not focused with their best people on the next tier down. And I'm talking about $5 billion and $2 billion and $1 billion companies. If you talk to the CEOs of those companies, they will tell you that the quality of investment banking advice has declined steadily over the last decade.
So they need new partners.
They do. And that's exactly what we're trying to do at Raymond James. But I think there are a lot of firms that are going to grow up here and fill this void in the market.
If they're going to fill the void in the market, what's the most essential ingredient? Is it people? Are you taking people from the big, bold bracket firms?
It is people. It's people who basically want to work in a more transparent environment. They want to have a compensation structure that's more tied to their own personal productivity, and they don't want to come to the end of a 5-year career and have a big bonus, a big payday, and find out that the stock's been destroyed and the firm's ability to even survive has been compromised by rogue traders playing around with the firm's balance sheet.
All right. Well, there's no compromise whenever you come on. You always give us the straight talk. I want to thank you very much, Fred Lane, the Vice Chairman of Investment Banking at Raymond James. Appreciate your insights and your thoughts. Thank you.